Just 2 months ago on this show, legendary investor Kyle Bass slammed the Federal Reserve here on the Claman Countdown. He blamed the March collapse of Silicon Valley and Signature banks on the Fed's aggressive rate hike path. First Republic hadn't even collapsed yet, which of course it did, and then had to be bought by JP Morgan. Since then, the regionals kind of seem to be on the road to recovery. But now Kyle Bass says, look out below, a couple more are going under. Let's bring in Hayman Capital Management founder and CIO Kyle Bass. You're skeptical of some of the regionals. What is at the heart of your thesis?
Yeah, hi, Liz. Glad to be back. Look, I think the important thing is number one, this issue is not systemic, like we saw systemic issues back in 2007, 8, 9. I guess that's the silver lining. But when you look at U.S. banks, we have about $2 trillion of total equity in U.S. banks, and we think that just the office portfolio alone of commercial real estate is going to cost regional banks $220, $230 billion of their equity. Now, if it were evenly distributed amongst the entire U.S. banking sector, that means the banking sector would take a 10% hit to capital. Again, not the end of the world, a bad year, right? But as you probably have noticed, there's no even distribution of these exposures. So there are several banks. Call it the top 20 exposures in the regional banks have their commercial real estate exposures at 400 to 600% of their equity. So if office is going to take 50 and 60% write-downs, what I'm saying is there are a handful of banks that will still have to be taken down. That doesn't, again, I'm not trying to be an alarmist. I'm actually saying the banking sector writ large is in good shape and will do fine.
Right.
But there'll be a couple of handfuls of other banks in the next year or two that end up succumbing to, let's just say, making bad decisions or poor decisions on a specific asset class. That's the way the cookie crumbles sometimes.
Well, teach our investor audience how to play forensic investigator to find that kind of weakness on a balance sheet, so they can certainly look at some of these names and say, wait a minute, I see here they have a heavy load of this kind of debt. I mean, we just saw PacWest unload about $2.6 billion of, at a discount, by the way, of some of these types of loans and some of this debt to, boost up its balance sheet. But how do you spot something like that?
Yeah. Look, I've been in financial markets since 1992 and have all of these, let's say, tools available to me that are fantastic, and relationships with analysts all over the street and also in our firm. So, there are plenty of listings out there, Liz, and maybe I'll post one post-interview. Again, I don't want to be seen as aiming a laser point at any one specific bank. I'm making a comment that's more broad-based, just saying, do your homework a little bit and make sure that their commercial real estate exposures aren't, 4 to 6 times their equity. And again, there are about 4,000 banks in the U.S. I'm only talking about 20 to 30 banks, right?
So yeah, but if you're piling into regionals and you don't know right now, it's really important. And we're always trying to help our audience to be able to spot this and make it a more sort of fair, democratic landscape when it comes to investing.
I agree. I watch some of the things that regulators say, of course, because we are regulated. I watch some of the things that some of the bank titans say, some of those people I truly admire. I don't want to be seen as causing a problem for these banks. I mean,
that's why I'm not asking you, Kyle, for an exact name. I know you wouldn't give it.
Right. They've dug their own grave by just making concentration mistakes. When you think about Silicon Valley Bank, they made a concentration mistake, even in government securities that were no good.
Well,
and also in depositors. The duration was no good, but with depositors that were also on the majority uninsured. So they kind of had the double cocktail that sunk them. And again, so that the weakest banks go down first, then you'll see a few handfuls of others. In the end, the good news is look, there is another silver lining. I think our economy slows down, pretty meaningfully in the next 12 months. And I think there's a great chance of additional huge frictions between China and Taiwan, which will slow the globe down, which means come next year, you're going to see rates falling and not rising. And that also will be a tailwind to banks at some point. in time.
Okay, Kyle, we have the next Fed meeting less than a month away. And I know you just said that these bankers dug their own grave. I would agree. But certainly somebody kind of fashioning the shovel would have been the Federal Reserve, according to you, because they raised rates way too quickly on the way up. But that said, what do you think the Fed is going to decide? The market believes a pause. We just had Rick Reeder of BlackRock saying, everybody says, well, they should pause, but will they?
Right. First of all, I love Rick. I haven't seen him in a while. But second of all, when I think about, they've raised 500 basis points in a year in which their expectations were for them to raise 75 basis points. If you look back to, January 1st of 2022. So they've kind of gone hog wild on the way up and into a marketplace where they expanded the broad money supply by 40% in 18 months. We're all talking about service workers' wages and the Phillips curve. And what we should be talking about is the simple price level. They moved the price level of homes and living by 40% over 2 years, right? Apartment rents went up 18% in 21, 18% in 22. So all these service workers simply have to earn enough money to be able to pay the rent. It's why they're working 2 or 3 jobs. It has nothing to do with the Phillips curve.
Kyle, great to have you. We got to get you back sooner next time because so much is going to happen between now and mid-June when the Fed meets. So thank you very much.